Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the Becoming a Treasurer series, author Craig Jeffery continues a mix of interviews around his book, The Strategic Treasurer, A Partnership for Corporate Growth. The chapter of discussion, Cash Boot Camp for Treasurers, provides a practical approach to understanding different perspectives of cash, how accounting and treasury can live in harmony, and more. Listen into the discussion. Welcome to the podcast, Craig.
Thanks, Meredith.
You know, it's been a while since we've talked and expanded on the popular podcast series, Becoming a Treasurer, so I'm looking forward to today's discussion. I'd like to continue our conversation around another chapter in your book, The Strategic Treasurer, A Partnership for Corporate Growth. You know, your book offers a great mix of topics and insights to help treasurers along in their career journey. And the chapter I'd like to cover today is Cash Boot Camp for Treasurers. To start us off, can you explain the purpose behind this chapter?
The focus of this chapter was to make sure that treasurers and anybody else who would be reading the book understands some of the different ideas around cash. What is it? How does it work? What are some of the different ways we look at it? In finance, accounting has a view of it. Treasury has a different view, similar, but different view. And I think that chapter, I started off with the quote, "I can't be overdrawn. I still have checks," as a playful way of addressing some people's views, not finance views, but some people's views on liquidity and I guess some of the old style payment methods like checks.
Cash is one of the most basic of all finance terms. While cash is certainly cash, can you share some different views and types of cash?
Yeah, the tautology cash is certainly cash is one way of looking at it, and people, can equivocate on the term. What does cash mean? Does it mean currency? Does it mean physical cash? Does it mean available cash that you have to spend? What are we referring to when we say cash? And that difference can vary when we think about cash. If we're formally trained in accounting, we think that the generally accepted accounting principle of cash is the way to go because there are certain principles that govern accounting. And something that's cash or near cash is treated as cash. And it may not take into account some of these ideas related to float or delays. And that doesn't have to refer only to check float, mail float. Can refer to any type of delays in the process. It could be posting in receivables, et cetera. So there's a number of different areas where people can have a different view of cash. And that's really important because how accountants look at cash is for general reporting purposes, is a general function of liquidity for their purposes. But there's a treasury view of cash, which is what funds do I have that are liquid? In other words, I can use them and they're in the right place, the right currency, the right bank account, then I can take advantage of that to pay down debt, to make investments in an efficient manner. And so those two perspectives can be very different. You can have in your financial statements, we've got $5 million in cash. Well, that might be true. It might not be even. You may have great cash needs in one place that you have to borrow on, and other areas that you have excess liquidity. So how do you manage that? And it's a very different purpose, financial reporting versus liquidity management. I think those are key aspects because forecasting has to account for bank geography specific activity, forecasting your cash, and it looks very different if you're doing it from an FP&A perspective. So location, liquidity, access, those are all some key concepts, and they differ even within finance as we look at cash.
So the chapter also provides an accounting-oriented approach as well. accounting entries may be a bit technical to share on a podcast discussion, but maybe you have some disbursement examples to shed some light on this concept.
Okay, I think you're referring to one of the disbursement examples in the book. I may come to that. I think, as you asked that question, it made me initially think of debits and credits, and you think of cash. I'll just use the example of the term when the bank says we credited your account for $5 million. Usually you're pretty happy because that means that your account went up $5 million. But they use the term we debited your account. Now, when you think about accounting, an asset account like cash, a debit is the positive side. So if you had a balance of $10 million in your account, you'd have a $10 million debit balance. And when the bank says we credit your account for $5 million, what does that mean? Does that mean that the credit reduced the $10 million down to $5 million? That $5 million reduced the $10 million by $5 million, so now you only have $5 million? No, it increased your account. So that $5 million credit from the bank is really an entry that you would record a $5 million debit. And for those that maybe haven't taken accounting or haven't been to an accounting class in a while, you're thinking, what kind of wizardry is this? That debits mean credits. And so that's another perspective that's different, between your books and the bank. So what that means is you view an asset, a balance, the positive side of a asset account is a debit. And so an increase is if you increase it, you debit the account to build it up. And you would take a credit if you dispersed some funds that would reduce it. So why does the bank say that they credited your account when you're saying, I need to put a debit on my accounting side? And for those that are familiar with this is probably a boring discussion. But the issue is that the bank holds your balances. They treat those as a liability to the bank side. They're holding your cash. And if you have 10 million cash, that's a credit balance on their books because your account is a liability to them. They owe you. It's not their money. They owe you 10 million. If they receive 5 million in, they credit your account 5 million. So now their liability has gone from 10 million to 15 million. So their account has gone up 15 million, but it's a credit on their side because it's a liability. Cash to you is a asset. And so you went from $10 million debit to $15 million debit. So it's on that side. So that's an element of confusion, between accounting, understanding if you're sitting in a different location. You're sitting in the company or you're sitting in the bank. Those make sense, but you just have to realize I have to think of what the bank says from the bank perspective, and I flip it on the corporate perspective. That's one, for example. I know you asked about a disbursement example. I think there's another element. I'll say it this way. You may have a disbursement payment a payment process is cut today. Maybe it's an electronic settlement for tomorrow, or maybe even it's a check run. Sorry for those that are outside the U.S. or Canada that don't know what checks are. But so the payment goes out. Let's say it has a future settlement date. The accounting entry is going to hit cash immediately, whether it clears tomorrow or a week from now or 10 days from now, because they view it as this is essentially cash. It's so near cash, the time difference is negligible, and we'll treat it as an entry to cash. Now, any self-respecting treasurer or cash manager, if there's a significant amount of funds that are floating or in delay, will use that cash. So there's elements on the collection side and the disbursement side where you have to treat liquidity as different from GAAP cash. So it's what is the cash I can use? I have to have it in a way that if I have it so I can use it, I want to use it. And I have to have it in the location where I can access it and use it to pay down debt, make other investments, or have an additional margin to cover activity or unsuspected items. I hope that provides a couple examples to think about cash from a few different views.
Yeah, that's an excellent summary to explain that concept. Let's touch on a little bit about accounts receivable. Can you share a little bit around this asset?
Sure. So, so on the AR side, I know I've talked about this with a number of people in the last couple of months. So it's like I'm reliving a couple conversations on this, but it's fun to think about. So the person in charge of accounts receivable, maybe it's the credit management role or the head of AR or the VP of the group. They're usually incented on working capital measures and reducing DSO, which is a calculation of what's the level of receivables that's out there and what's the average day. And so how does that translate? Hopefully that wasn't too much for a podcast, but the idea of if a group is behind posting the receivables, let's say they get a bunch of funds in today and they're only able to clear some of it. There's too much. They can't post it. They don't know which outstanding invoices, their billings, they can't clear it to the billings. Well, they may not post it to cash if they only record it through AR. So let's say they left 5 million unposted. Cash is going to be 5 million short in their financial statements for that day or that month end because they didn't post all of the cash that was received. So the entry doesn't hit cash in a traditional way of posting items. And so that can create a bit of a whipsaw or a fluctuation in terms of cash, where let's say it was received electronically, it was all available. There's 5 million more cash. And so if there's any variance or delays or timing lags between items in the bank, whether they're available or not, and timing, those can move the reality of liquidity up and down as compared to an accounting measure and process. And so that creates some whipsaws. And there's certainly ways to address that better, particularly with technology that exists today.
Mm-hmm. Well, that brings me into my next question. Has new technology provided treasurers and controllers the ability to meet both reporting and cash management objectives more efficiently?
Yeah, I think so. There's processes and there's technology. If we think back a number of years, we didn't have all the technology that allowed us to post transactions from the bank, from integrated lockboxes or integrated receivable systems or payables platforms as effectively. And what that meant was that you would usually have the subledger, i.e. the payable system or the accounts receivable system, that would create the entries to cash. And then let's say if it's on the receivable side, they'd relieve the receivable. They would debit cash for the receipt of cash, and they would credit receivables, which would reduce the receivables because that amount was no longer receivable. It was cleared. So they're relieving the receivable. So that's coming down. If you have a delay or this latency issue of recording, you've made your actual liquidity that you can use different from what the financial cash books say in the organization. So that creates the problem. Well, how can technology help with that? So technology can help with this is, Treasury maybe getting feeds from all of their banks on a daily basis, on a prior day basis, or even on a real-time basis. They can have the technology set up with rules and logic-based rules that will create all of the accounting entries that will hit cash, all the cash that's received. It'll create the debits for those. It'll create all the credits for every disbursement as it clears the bank. Those can all be made on an automated basis. Now, that can be done for those that might be receivables or payables. Now, as you may remember, just a few moments ago, I said AR might be debiting cash for the receipt, and they might be crediting receivables to reduce or relieve the receivables. So now if Treasury is booking the cash received, what's their offset or what's their credit going to be for the receivables, because you don't want to book it twice. So the debit to cash could be made by Treasury. their Treasury platform or system. And the credit could be a cash clearing account. And AR would hit a cash clearing account. Now, those cash clearing accounts are treated as cash for GAAP purposes, so that, if Treasury's hitting a debit to cash and a credit to cash clearing receivables, for example, those are both treated as cash entries, but you could say what's the real cash by looking at cash. And you could look at cash clearing on the Treasury side, and then AR would debit cash clearing, which is another GAAP cash account, and then the individual clearing items. And what that means is everything that comes in could be automatically booked to cash by Treasury. And then as those receivables are relieved, no matter what the timing difference is, they would book the cash clearing. And so everything that's related to receivables would be, the cash side would be booked by Treasury. The cash clearing would match up exactly from Treasury to the cash clearing side on the receivables standpoint. And what that means is when you run your GAAP cash, you're in compliance. You just simply total the cash and cash clearing items, but Treasury can look at cash, and they can also see where there's a delay in posting by examining the specific cash clearing accounts. And that's not possible or recommended if everything's manual, because you're saying, hey, everything that hits the bank, now I'm entering it twice, and I've got to reconcile between the two. And that would be insane in a manual world. That wasn't done. But in a digital world, all those entries can be made automatically. So they take almost no time. They're matched quickly, and it provides a secondary control point of balancing between everything that hits the bank cash side is booked by Treasury, and then matches off to those areas that may have subledger activity to do with cash to the cash clearing account. And this is a real significant change that companies started doing probably about 15 years ago, and it's really moved through many, many companies. And that's only really possible through the use of these automated rules and technology. I know that's probably a longer answer than you wanted, but you got me going on it.
No, it makes good sense. So understanding the different needs and perspectives of cash is of great value to the treasurer and Treasury. What are the key concepts to remember?
Well, cash is king. I think that's one. It's, the liquidity is super important. That's more important than paper profit on the books. If you don't have liquidity, you can become insolvent. So that's one. Second, the term cash and perspectives on that differ from the liquidity view of cash for the treasurer to the GAAP-oriented view of cash by the controller. I think that's the second point. The third one, when Treasury looks to optimize things from a Treasury perspective, they can and must address them in the manner that is compliant with GAAP reporting needs. And I just described a way that makes them that way and meets some of the more advanced liquidity needs of most medium and large size Treasury groups. And, finally, the ability for Treasury to do this cash recording on an automated rules-based system is superior from a control perspective and helps improve the financial records of the organization, the accuracy, the ability to track those. I think those things taken together are quite significant. It's not a us versus them, accounting versus Treasury, Treasury versus accounting. We can argue about cash. Both views of cash are valid, and they need to be taken into account. And I think that's that will help us look to the win-win situation. And it's really a lot easier given some of the new tech that's out there.
Yeah, that's a great summary. Craig, any other final thoughts as we wrap up our discussion?
No, it was fun talking about cash and accounting. So thanks for your time, Meredith.
Yeah, absolutely. Thanks for your time as well and sharing some insights from your book. If our listeners want to get a copy of your book, is there a way that they can do so?
There certainly is. I think in the show notes there's information. So the Strategic Treasurer is offered by Wiley & Sons. I think you can get it wherever digital books are sold. I think there's quite a few locations to get the hardback version as well.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.